My name is Peter Kolm, and I'm a professor at the Courant Institute, New York University. And it's a great pleasure to be here, and I want to thank the Storm organizers for giving me the opportunity to speak about some recent advancements in AI and machine learning for trading. And given the short amount of time that we have here today, I've decided to focus on a topic that's received a lot of attention in the last few years or so, and that is to use full order book information or a sequence of order books to predict stock returns at intraday horizons. This is joint work with Nicholas Westray. Starting off, let us set the stage. The stage here is that of systematic trading of U.S. equities at very high frequencies. This is, of course, of great interest to sell-side and buy-side practitioners, sell-side broker-dealers. They, of course, want to improve upon the performance of their trading algorithms that they provide to clients, and buy-side practitioners want to build and develop profitable high-frequency trading strategies. It's probably fair to say that the holy grail for many of these firms is if we were able to take the full order book as an input, stick it into a model, shake that order book, and out comes highly profitable return forecasts. That is currently not what's being done typically. Rather, these firms employ quants to extract and handcraft the features that are based on often human domain expertise. And these alphas that are built become high-value IP for the firms. Signal generation of this kind is very challenging for a number of reasons. As you can see here, enormous amount of data sources. It's a very competitive space, and everyone is looking, of course, at the same data at the same time. Now, what is the data? The native object that we're going to be looking at is that of an order book. And here we see the bid side in blue and the ask side in yellow. The different bars correspond to different levels of the order book. The best bid and the best ask are the first level. It's on the bid and the ask side. The difference between the bid and the ask is, of course, the bid-ask spread. The length of the bar, or the size of the bars, correspond to how much liquidity is available at each one of these levels. And traders and other market participants interact with the order book by placing market orders, crossing the bid-ask spread, or placing limit orders or canceling limit orders. The work that I'm going to summarize here comes from a number of articles that we have published in the last few years. The first one here, deep order flow imbalance, extracting alpha at multiple horizons from the limit order book, has appeared in Mathematical Finance, but it's also available in the public domain. And a lot of the work that I will be talking about here today is coming out of this recent article that we've released this spring, called Improving Deep Learning of Alpha Term Structures from the Order Book, and that you can download from SSRN. Some of you may also be interested in the article here called Information Content of Cross-Sectional and Multi-Level Order Flow Imbalances. And this has more to do with a cross-sectional effect across stocks and predictability, as well as price impact across stocks. So the basic problem statement here is that of taking a state vector that consists of the full order book at the individual stock level. So for the first level, we have the ask price, the bid price, the volumes in each one of these sides, and we're looking at 10 levels deep into the order book. So 4 times 10 is equal to 40. And this state vector keeps track of the information that is flowing in and out of a stock's order book. And whenever there is a new message to the order book, the state vector is updated. And that is also to say that the time series of these state vectors is an inhomogeneous time series. So the timestamps here are not equidistantly spaced. The forecasting problem that we are looking at is to forecast what we call alpha term structures. These are rate of returns at different horizons into the future. These horizons are going to be stock specific. I don't have to have enough time to explain exactly how we do that in this work. I refer you to the articles. Suffice to say that these are returns at different horizons that are stock specific, that depends on the activity in a particular stock. So we're going to try to forecast these alpha term structures using a neural network, G, and basing that of past information from the order book. And of course, there's a number of different questions that arises in a setup like this. The key questions here that I'm going to consider today is, first, can we use the full order book, the raw order book, and stick that into a neural network? Or should we transform the order book before we do the prediction exercise? And if forecasts are reasonable, are there certain architectures that are better than others? And if there are alphas, what kind of horizons can we expect from these alphas? So since order books are non-stationary objects, transforming the order book into something that is stationary is reasonable. A reasonable contender to using the full and the raw order book. There are many different ways in which this can be done, but a natural and canonical way of doing that is to use order flow imbalances, which is a nonlinear transformation of the order book. Here we transform each side, the bid and the ask side, to order flow according to this transformation. And then we combine these order flows into order flow imbalances. So an order flow imbalance is the difference between the bid order flow and the ask order flow. It's well known that order flow and order flow imbalances are a stationary time series. So these are ideal candidates to explore as alternatives to the full order books. And the data that we're using is about 13 months of lobster data. We have 115 stocks that are the constituents of NASDAQs over a period from January 2019 through the end of January of 2020. This is a very large data set because it contains all the messages to the order book. So it's about 10 terabyte uncompressed. And we built a specialist infrastructure to process and store all of this data, and also being able to have fast retrieval of the data as we are training our models. We define stock-specific horizons as we are defining these alpha term structures, as I mentioned, and they're based on a time scale that we call the number of average price changes. So alpha term structures are subdivided into the number of average price changes at that scale. And we're going to be looking at a scale of up to 2 average price changes, and a little bit later up to 10 average price changes as we train our models. In the first exercise, we're going to compare a number of different models: an autoregressive model, a multi-layer perceptron, a long short-term memory network, and also a deeper LSTM type of models. Many of these have been used in other studies, many of which used much smaller data set, and therefore the results are not as conclusive. So that's why we include these models in this study. We're also going to be using a CNN LSTM, which is a model that was proposed by Zhang, Zhou, and Roberts in 2019. So first question, should we transform the data to order flow imbalances, or should we look at the full order book? If there is predictability, which ones of these types of models would perform better on these types of inputs? And we have order flow on the left-hand panel, and we have a full order book on the right-hand side panel. And you observe that the out of sample R squared goes up to about 1% on the right panel here, and almost 1.3% for the left-hand side panel. So the answer here is very clear. It looks like these models, these neural network models, perform a lot better once we have transformed the data to a stationary form. And this might be surprising to many of you, saying that, well, these neural network models should be able to take non-stationary data and transform it to something of a stationary output, that of returns. But the short answer to this question, or this conundrum, is that although we have a lot of data, we don't have enough data to learn the inherent structures to tease out exactly the kind of information that we would need in order to, in some sense, automatically transform this non-stationary data to something stationary. So doing that ourselves shows a significant performance increase. If we look a little closer into these models, we also notice that the MLP and the autoregressive models deliver very weak performance, whereas all of the models up here, they have something in common, and that is they are LSTM models, long-term memory models. And if one goes and statistically tests whether the performance of these models are statistically different from each other, the answer is no. These models have more or less statistically the same performance. So in a lot of the subsequent work, we focus on the simple and the basic LSTM, because these models are statistically very similar. Another question might be, how far out is their predictability? And here you're seeing that in terms of the fraction of average price changes across all the stocks, predictability peaks at around 2 or 3 average price changes, and then it decays up to about 10 or 12 average price changes, right? You see the scale here, outer sample R squared goes from about 0.6% here up to about 1.2, 1.4% at the maximum. Now, can these types of models improve? Well, you might say, well, have you tried some of the more modern sequence-to-sequence and transformer-based models? Can one also tweak hyperparameter tuning? Can one tweak the architectures? Can additional features, such as the time features, be added to the models, thereby improving the performance? I'm going to share some of those results with you here. And additional models that we added in this follow-up work, we're using a multi-head LSTM, where each LSTM is training a return forecast at different horizons. And then we have sequence-to-sequence type of models, where both the encoder and the decoders are LSTMs. We have the sequence-to-sequence models without attention and a sequence-to-sequence model with attention. We have also looked at transformer-based models, but I'm not going to share those results here today. So here we see a performance comparison again across all the 115 stocks. And we're looking at the performance in the units of average price changes from 0 up to 2 average price changes, and the out of sample R squared goes up to about 1.5 here. And we are seeing that the sequence to sequence with attention does not perform particularly well. And the multi-head and the standard LSTM and the standard sequence to sequence model have roughly the same performance. And if one were to go and statistically test whether these models are delivering statistically different return forecasts, the answer is no. They deliver statistically very similar type of forecasts. So the answer here is that it's very hard to beat a standard LSTM. Now, turning a bit to the question of whether one can tweak these models, one can improve the model performance of the LSTM by decreasing the batch size. This is well known from the broader machine learning literature, where smaller batch sizes tend to generalize better. We can change the architecture of the LSTM. We can make it deeper. So in one case, we have a deeper LSTM. We have wider LSTMs, and it's very marginal improvement here. But if one were to say something here, it's more important to add an additional level of depth rather than width to improve upon the performance. One can add additional features, and one very natural feature to add in this kind of setup, because we're looking at order flow imbalances and raw order book inputs that are non-equidistantly spaced. So therefore also feeding some information that contains time. So timestamps is a natural extension. So we looked at a few different ways of representing time, duration between the updates to the order book, so that's delta T, time of day as a fraction of the trading day, a standard time to vec representation, and also we added date features such as that of day of the week, day of the month, and day of the year to see if there is any seasonality components. And here's what the answers come out to be when it comes to the time features. If we are grounding ourselves by looking at the LSTM with no time features, that's the dark blue line here. So this graph is suggesting that adding time features adds some benefit, although it's not enormous. There's certainly some benefit to add a time feature. Exactly which time feature to use matters less. It's like splitting hairs in this case. Adding various kinds of date features actually decreases performance, certainly as to be expected. There is no daily or weekly or monthly seasonality in these very short-term time series prediction problems. Here's another way of looking at the out of sample R squares with the time features broken up with the predictability across the day. And we're seeing that we're peaking here on average a little bit after the open, about an hour or so, an hour and a half after the open, and then towards the end of the day. I want to conclude by saying that we built a very robust computational framework to evaluate different kinds of inputs and deep learning architectures for this kind of return prediction, using full order book data across a broad range of stocks. We have demonstrated that stationarity of the inputs seems to be critical to getting good outcomes, and simpler architectures in the setting performs as well as complicated ones. And in other words, it's very hard to beat a simple LSTM. However, we can improve upon the performance of the LSTM by doing hyperparameter tuning, increasing the depth at least one level improves a little bit, and also including time features seem to improve the performance of these models. So with that, I want to thank you and just show you again here the slide of how you can find our work. Thanks again for your time and attention today.